Hi, Ignatius Jackson CPA here. Hope everybody's doing well. Wanted to touch base with you today regarding some year-end tax tips and strategies to consider as you approach the end of the year. So if you hear something that interests you or want to talk to us further about it, feel free to reach out to us. We have about 10 days left to go through and do some of these strategies. Some of them you could do through April 15th, and some of them have to be done by the end of the year. So definitely let me know if you have any questions or thoughts on any of these items. Okay. One of the things that came with the CARES Act that is still eligible if you haven't done it already is you can make a $300 charitable contribution to a 501c3 charity of your choice. And that is an above-the-line deduction, meaning you do not have to itemize on your tax return in order to get that. So you can do the charitable contribution plus the standard deduction for $300. Okay, so that's a nice little bonus that came out of the CARES Act, and that is per tax return for 2020. Okay, so per tax return, so meaning if you file joint, it's still only $300. Okay. You should consider converting your IRA to a Roth IRA. If you have traditional IRA dollars, you should consider converting those to Roth IRA dollars if you had a low income year. So if this was a bad year for you, lost a job, had less income in your business, something like that, maybe you want to consider converting your traditional IRA dollars to Roth dollars. That does have to be done by 12/31 if you wanted to count towards this tax year. So not a whole lot of time to get that done, but most of the custodians should be able to get that done for you if that's something you want to do for 2020. One of the main reasons why you want to convert to a Roth IRA instead of having traditional IRA dollars is the ability to have earnings that are not taxed, okay? So let's just say, for example, you have $10,000 that's sitting in a traditional IRA. Let's say you, over 30 years, you have a 10% annual average return. That can turn into $188,000. Over that same 30 years with a 7% annual return, that profit that you make on that investment will be $71,000. So in either scenario, the return is a lot larger than the initial investment. So the question would be, would you rather pay taxes on the $10,000 or would you rather pay taxes on the $188,000 or the $71,000? So even if you have a much higher tax rate in 2020 than what you think you might have when you retire, if you have all those earnings that are tax-free, 100% tax-free, it still is likely going to be more beneficial to you. So just another way to think about it, not so much just what your tax rate is, but also what the earnings potential would be over that time period. Okay. Another thing to note, if you have an S corporation, definitely make sure to review with your accountant, CPA, whoever kind of helps you with your taxes, your W-2 and your K-1 split to make sure that it's somewhat reasonable. This is a huge issue with the IRS, and so you definitely want to consider your W-2 to K-1 split. Now, if you didn't take any distributions and you didn't pay yourself anything at all, whether it was a W-2 or a distribution from your S corporation, then you do not have to worry about that W-2 K-1 split because you don't technically have to give yourself a W-2 if you didn't take any money out of the business, okay? However, if you did take any money out and you have not given yourself a W-2, that is a huge no-no. So definitely wanting to pay yourself something because it's a lot easier for them to dispute you not paying anything at all than it is to dispute how much you pay yourself, okay? So definitely look at that before the end of the year. Another thing, if you have an S corporation, definitely make sure that on your W-2 you include your health insurance and 401k contributions, okay? So health insurance is important to include on there, like dental insurance, vision insurance, all those types of items. It does have to be included on the W-2, and you do need to get either reimbursed from the S corporation or you have to have the S corporation pay the payments directly. Okay, so if you pay the payments out of a personal account, the S corporation has to reimburse you. If you pay it through the S corporation, then you're fine, okay? But it is important to include it on your W-2. If you don't include it on your W-2, then technically you don't get a deduction for those health insurance costs. For the 401k, if you make a contribution to a 401k, let's say you have a solo 401k for your S Corp, you want to make sure that that contribution is included on your W-2, especially if it is a pre-tax contribution. If it's not included on your W-2, then your your taxable income will probably be off when you go to file your tax return. So very important to make sure that stuff is included when you have an S corporation. One thing you also may want to consider if you don't have a 401k is starting a 401k before the end of the year. So if you don't have one, you can definitely start one. There's still time to do that as long as you don't have any employees that work more than 1,000 hours and have been with you for more than a year. So there's still some time to do that. Otherwise, if you do have employees, you can do a SEP IRA and start that up anytime between now and when you file your tax return. The one downside to a SEP IRA, however, is that you do have to give your employees the same percentage that you give yourself as a retirement contribution. So it's usually going to be more beneficial to do a 401k than it would be to do a SEP IRA. But unfortunately, if you have employees that are eligible, the time frame on doing a 401k, Safe Harbor 401k has passed. So you may be unable to do that for this year. All right. Another thing to consider is to look at what purchases you need to make. And let's say this is a low income year. Maybe you don't want to make those purchases this year. Maybe you want to push them off until 2021, a couple weeks out. If you have a high income year, then maybe you want to push some purchases forward and maybe buy them by the end of the year instead of buying them next year, especially if you think that your income is going to shift one way or the other going into next year. So that's another thing to consider and think about. But my recommendation generally is not going to be to buy something just for the deduction. You should really only buy stuff if you actually need it. Because you got to keep in mind a deduction is not dollar for dollar like a tax credit. It's basically just reducing your taxable income. So it's really only a percentage of the money that you're spending that you're saving in taxes. So again, don't buy stuff just to buy it. But if you really do need it and you're going to buy it anyways, then figure out what makes sense in terms of timing. If your tax is a sole proprietorship and you have a single member LLC and you're making more than $40,000 in net profit a year, then you should definitely call us before the end of the year because we can do something to get you set up as a late S corporation, which will save you thousands on your taxes. So if you don't know how much you're making in profit, just take a look at your previous year's line 31 on your Schedule C, and it will tell you how much of net profit you have. If that's more than $40,000, or if you think it's going to be more than $40,000 for 2020, then definitely want to get in touch with us so that we can save you some money. Okay? If your kids helped you out in the business at all for 2020, one thing you want to do and consider is paying them instead of just giving them the money. If they helped you out in the business, let's say they did your social media, or they answer phone calls or some things that they can potentially do, definitely want to put them on the payroll. Something that I've talked about before. It's definitely a great way to get some business deductions while still at the same time the kids, if they're under 18, don't have to pay any taxes. They don't have to pay payroll taxes nor income taxes. And they're also eligible to contribute the money to a Roth IRA. Okay, so super powerful strategy if you do have some kids that are helping you in your business. But again, they would have had to have helped you in your business throughout the year and you just hadn't paid them yet. So if you haven't had them helping you in the business, then definitely something to look at going into 2021 to get them involved. But there's a special way you have to do this, especially if you have an S corporation or a C corporation. So definitely want to touch base with us and get in touch with us so that we can help you get through that, those muddy waters, I guess you can call it, and make sure you get it done the right way, all right, so that you save money and don't get yourself into trouble. If you have any capital gains that are stored up, especially with the impending administration change and the potentiality of some tax changes, you may want to consider taking that tax hit this year. And if your income is super low this year, it may even make more sense that you want to take the tax hit this year, because you could get as low as 0% taxes on those capital gains depending on how low your income is. So definitely something to think about and consider as in terms of tax planning is going ahead and maybe selling some of that stock or whatever it is that you are sitting on that's a capital gain, and making sure that you save yourself some money on taxes potentially. Okay, or even if your income's about the same as it is normally every year, Still might make sense to hedge your bets a little bit and maybe sell a little bit, maybe not all of it, but sell a little bit of it, to where if the capital gains rates do go up significantly next year and you're in that high income bracket that they're talking about increasing it for, then you get some more favorable benefits. Okay. Another thing to consider if you have capital gains is to do an opportunity zone investment. So this is an awesome income tax strategy to save you money on the earnings from that investment over a 10-year period. So definitely an awesome ideal to think about if you have a 10-year horizon on needing that cash or that capital. Definitely something to think about doing with those capital gains that will help to save you money on your taxes. And then the last couple points to touch on would be in regards to Roth Iras. It's definitely something that we want you to think about making a contribution for 2020. So we talked about converting traditional IRA dollars to Roth IRA dollars, but we can also make a contribution for 2020 for Roth IRA dollars. And you can still make a contribution even if your income is above the standard threshold to make a standard Roth IRA contribution. Is called the Backdoor Roth Ira, where you basically contribute to a traditional IRA that's non-deductible, and then you convert those dollars over to Roth IRA dollars. In order for that strategy to work, though, you do need to not have any traditional IRA dollars or SEP IRA dollars or simple IRA dollars that you already have. Otherwise, that strategy doesn't work that well because you still have to pay some taxes on those traditional dollars. So, but other than that, definitely an awesome strategy to get you some more money into the Roth IRA. And you have until April 15th for that strategy, okay? And then for the HSAs, last one I'll touch on is in regards to HSAs. You have until April 15th again to make contributions to the HSAs. You can get $7,100 if you have a family, or $3,050 if you're single this year into your HSA. In order to contribute to an HSA, you do have to have a high deductible health plan, but HSAs are powerful tools because you get a tax deduction on the money going in, and you don't pay any taxes on the money coming out as long as you use it for medical expenses. So super powerful tool, definitely something you want to think about and consider doing. Well, that's it for these year-end tax tips or tax strategies to consider. Thank you for listening. This is Ignatius L. Jackson, CPA. Happy to have consultations or talk to you guys about any of these strategies. If you have any questions, feel free to reach out to us and we will get back to you as soon as we can. We're obviously super busy going to year end, doing some tax planning and things like that for our clients, but definitely can do what we can to help you out along the way. So feel free to reach out to us. And we will be talking about the recent passed legislation. We just need a little more time to digest it, so that will be in a future video in the next couple of days here that I will post that will have all those great fun facts in there. There's some really cool stuff and good stuff in there, though, just to give you a little forewarning and a little bit of a teaser. So definitely want to check out that next video in order to make sure you're saving yourself some money on taxes and helping your business to survive this wonderful pandemic. Not so wonderful, but this issue that we're dealing with right now. So thank you all for listening. Feel free to leave us any comments or messages or anything like that, and we'll get back with you. And hope everybody has a happy holidays.